Hi everyone. My name is Kelvin. I am the CEO of audax, a venture established and incubated by Standard Chartered Ventures. What do we do? audax provides a bank-in-the-box solution that allows any bank to spin up their either digital bank or banking-as-a-service capabilities within 6 to 9 months. Right. Now today we are very lucky. We have a fantastic panel of friends and colleagues and acquaintances as well to talk about from obsolete to absolute with banking-as-a-service. We expect it to be very exciting. We expect to talk about and push the boundaries of what is acceptable within banks and create scalable digital banking models. I would also like to take the opportunity to announce the launch of our joint white paper between audax and Thought Machine on banking as a service. So for those of you who are here, please grab a copy of it, have a look. Please let us know any feedback you might have or spread the word as we see many banks across the world moving towards a scaled digital banking model and banking as a service being at the forefront of the embedded finance discussion. Now, without further ado, I hand you over to the moderator of this panel. Thank you very much.
All right. Can everybody hear me okay? Fantastic. Cool. So maybe to introduce myself quickly, Emmanuel Coucke. I'm a partner at Bain based in Kuala Lumpur, one of the leaders in our financial services practice, and have the pleasure working with a number of fintechs and banks on banking as a service. Maybe before we get started, you guys want to introduce yourself as well?
Sure, and probably everyone's wondering, that's not Eileen. So my colleague got sick this morning and then asked me to step in, so I'm happy to. Obviously I'm not as beautiful as her, but I will try to make up for it. Also, probably a lot of you are wondering, what is this in his face? So I'm participating in November for men's health and prostate cancer. I work for AWS. I'm part of the Worldwide Financial Services IBU and help banks and with a focus on digital banks across the APJ region.
Your name is?
Come.
Your name is?
Oh, I didn't mention my name. Good point. Yeah, my name is Felix Tummernicht. Yes, thank you. Andreas.
Yeah. Thanks so much, Felix. I'm Andreas. I'm based in Singapore. I work for Thought Machine. I'm actually leading the sales engineering function in Thought Machine for Asia Pacific. Thought Machine is a core banking technology provider out of UK, so we are invested by SC Venture. Very amazed to be here today to speak with our friends audax, AWS, and Bain about banking as a service.
Hi everyone, Mike Breen. I'm from audax. We are as Calvin said, we are a plug-and-play digital bank with focusing on banking as a service. We are incubated out of Standard Chartered Ventures, so it's nice to be home a little bit as well.
All right. Maybe before we get started, I still think there's often a little bit confusing around what banking as a service is. And so just to make sure we're talking about the same thing. Mike, would you mind just talking us through that very briefly?
Sure, thanks. So banking as a service and embedded finance very often get mixed and the words are interchanged with each other. Banking as a service is a technology rail that a bank executes out via APIs, microservices and capabilities to partners outside of the regulated industry who provide embedded finance, which is a consumer experience or an experience outside of the boundary of the financial domain or of the regulated environment. There's actually kind of 3 models as well for banking as a service. The first one is where you have what we call a headless bank. So the bank, the technology company has its own banking license and delivers regulated financial products as a headless entity out to partners. So a good example of that would be Solaris Bank in Europe. You then have the next model where you have a technology company who rides on the balance sheet and the regulatory framework of a bank, but doesn't have a direct relationship with them. And they then sell financial products out to the third part, to the market, using somebody else's balance sheet. So there's been a lot of use cases in the US and Europe of those types of environments as well. And frankly, we believe that is quite a risky scenario for the partners because they're relying on somebody who's semi-regulated, but also for the banks because they are now leaving money on the table fundamentally. They're allowing somebody to monetize their balance sheet without them getting direct revenue. Which then leads to the third model, which is what we'll really talk about today, where the bank themselves provide the technology framework and have the direct relationship with partners, fintechs, or potentially other banks to provide those regulated financial products upstream into the partner domain.
All right, brilliant. And so why we're excited around banking as a service and that we really wanted to talk about that today was actually 4 reasons. So the first one is around, the customer is really changing. So if you look at the data out there, customers feel a lot more comfortable buying financial services from non-banks, and especially when you kind of look at the age profile, it's really interesting to see how younger people really don't value the bank brands that much anymore. So that's one. We all get a lot of hypes, but banking as a service is no longer a hype, right? There's still massive numbers floating out there, how big it's going to be in 2030, but we're way past the hype. We have a lot of clients that have already delivered on hockey stick growth. You see what's happening in Europe, and it's really starting to take off here in Asia as well. And that's really the third point. In Southeast Asia, it really feels like a land grab at the moment. So who's able to actually deliver the technology to enable that, but who's actually able to make sure that you have the right partners on board? Because there's a huge amount of demand from, people like yourselves, fintechs, etc., to kind of offer that to their customers. And then the last one, which a lot of people here in the panel will agree with, is that it's a lot easier from a technology perspective to offer this today than it was even 24 months ago. So that's why we really wanted to talk about this today. Now, rather than starting to delve down into technology, I'd love to kind of start with some real examples within Southeast Asia that have been very successful. So, Mike, maybe if I can come back to you and you can share some of these success stories that you guys have had in Indonesia.
Yeah, absolutely. So audax is a technology provider to Standard Chartered, and we deployed a BaaS use case or a BaaS platform into Indonesia. And the first use case there was Bukalapak, which is a large e-commerce play. Have about 120 million retail customers, about 20 million sellers, SMEs in their ecosystem. And Standard Chartered partnered with them to deliver end-to-end retail products, and what they've actually launched is a product called Buka Tabungan, which is a digital bank, branded as a digital bank, completely standalone from Standard Chartered, but utilizing the Standard Chartered license, regulation, balance sheet, risk. And this has been, for Standard Chartered, incredibly powerful because from launch, which is about 9 months, Buka Tabungan has tripled the Standard Chartered Indonesia customer base just in 6-9 months, an incredibly quick scenario. This will carry on further for Standard Chartered. There was some indication given from them last 2 weeks that they're launching in Malaysia very soon with a large fintech. And again, this is going to really accelerate the use case and frankly the revenue opportunity for the bank in a very tough market.
Yeah, thanks, Mike. And you mentioned a launch coming up. Felix, you'll probably have most conversations in the market given AWS. Can you kind of give us a sense around how many people are kind of looking at banking as a service?
I would say if you look across the APJ region, everything started about 2018 with the kind of licenses new being issued, deposit license, all the way from Korea to at this point even Pakistan, right? So 60 plus new digital banking license, right? To your earlier point, the customer expectation was the driver for that. But what we basically have seen afterwards is that, hey, all these digital banks are able to build a customer experience that is superior to the incumbent banks. It was much closer to what consumers were expecting in their day-to-day life. So the always on, the always real-time experience that, let's say you get a Netflix and all that, is what you also want in your financial services engagements. So if I look across the region, every bank is right now looking at, okay, how can I create a better customer experience, can compete with these digital banks that are now entering my market. And how can I do it with the winning recipe? And if you then look across some of these winning recipes across the market, obviously there's business model and technology, but I think the key differentiator is the integrations into an ecosystem. So a lot of the successful ones had an ecosystem approach. They either partnered with the supermarket, with the telco, with some sort of other access to a large set of customers. And that I would refer to as the ecosystem approach. And that is where now the majority of banks are looking at, okay, how can I do it? And the answer is, yes, you can build it yourself, or you can go with the banking as a service partner. And that's what we are seeing quite a bit.
Yeah. And maybe the next one for you, Andreas. When you have discussions with banks that are going down this route, or with fintechs that want to kind of be a partner to banks, what are some of the key things that they're really looking for? What problems are they trying to resolve?
So from our point of view, and the conversations that we have across the region, is I think the initial push into banking as a service or embedded finance, or like how we like to call it, is like increasing your kind of like outreach through like an ecosystem and partnership model that banks need to achieve. We can basically see that the rise of the interest rates has put quite an enormous pressure on the banks because they obviously had like a much higher customer acquisition cost that they had to deal with, and how to basically diversify their kind of like strategies to acquire new and a diverse set of like new customers to the bank, or with kind of like the new rising of digital banks and non-banking players in the market that basically cannibalize the market for the incumbents. So basically the banks that we were speaking to, they had to come up with ideas and strategies of how can they basically redistribute some of the marketing costs that they have to basically put up every year to acquire new customers and generate new revenue streams. And what we found is that redistributing these marketing costs into like technology costs by modernizing the infrastructure and the technology that is being deployed to enable those kind of like user journeys where you can expose your financial services, where you can expose your APIs and your data, so that ecosystem players and partners can leverage of it, and then basically, if you like to say, outsource that customer acquisition into third parties and have them pay for the marketing. I think that's what we are seeing as a trend in Asia Pacific at the moment. What is the issue with that? Obviously, is that most of the incumbents are still stuck in technology that they have deployed like 20, 30, 40 years ago. And how can you basically create those user journeys and expose your data and functionality into the wider ecosystem? And this is where Thought Machine and audax basically can work together very seamlessly, because we provide that technology on a cloud platform such as AWS and give the banks the opportunity to develop something like this.
Yeah, thank you. Mike, anything you want to add to that?
Yeah, and look, the customer acquisition cost, I think, is the key thing. But also, and you touched on at the beginning, brand resonance. If you're a legacy bank or an incumbent bank, and you're trying to appeal to a new market demographic that is now getting drawn to digibanks, that's where they're targeting. How do you make yourself relevant? Your brand itself may not have a relevance to that individual, and you could spend hundreds of dollars trying to create relevance to no avail. So leveraging the brands of other entities, whether it's a retailer, a fintech, an airline, a supermarket, whatever it may be, that hits that brand, it hits that demographic, is a much more efficient way of investing and a much better way of building your business. Because it also, by having a lower customer acquisition cost, it opens up those demographics who potentially have a lot lower spend in the initial years. So if you were spending, for example, $100 on a customer acquisition cost, and you're only going to earn $30 in revenue of that customer, you're never going to target them. But if it's $1 to acquire a customer and you can earn $5 of revenue out of them, it's suddenly a business case that can fly.
Yeah, thank you. And from all the conversations I've had, I find it really interesting to see how fast the technology space has moved here. So if I look at banks that tried to do this, even only 3 years ago, the one question that I always ask is, what would you do differently? And they said, we had to build everything ourselves, and now there's so much, I wouldn't call it off the shelf, but so many partners that you can partner with to kind of just get this to market so much so much faster. And that comes back to the land grab that is happening today in Southeast Asia, of kind of locking in all these partners. Maybe before we go into the next set of questions, anything from the audience that they want to ask this esteemed panel?
Felix, you were talking about. Oh, okay, thanks. You were talking about ultimately stickiness, right? So this some of these institutions, like the international one, maybe the banks are using an e-commerce player, retailer, to create that stickiness to target, a new demographic. The problem that we're seeing with a lot of our banks that we deal with is that, okay, it creates stickiness for a short period of time, but that demographic is also the type of demographic that can bounce from bank to bank. And so how can we create that stickiness, for not just the digibanks, but also the traditional banks? So I think that's one question I wanted to ask you guys, like how are you guys seeing that? And I think the other side is, okay, great, customer acquisition cost can be $1, but then how do you create margin play on those customers as well? The whole point is great, we've acquired the customers, how do we keep them, how do we margin play off them? So, 2 questions, okay, for the next section.
I'm not going to throw anybody in on the deep end, so who wants to take this one?
So I think on the first part of the question I can maybe answer to that, because this is some area that we've been looking into. So I think stickiness of customer might not be so much of the expectation of the customer experience itself. I think if you take a look at Buy Now Pay Later and the kind of like revolution that has created in the market, we could see basically that customers don't care where the money is coming from, as long as it is easy to access and it's like seamlessly integrated into the user journey. And I think from a customer point of view, that will only go beyond Buy Now Pay Later in all of the financial services that we are using today. I think we are in a generation where people grow up with the mobile phone in the hand, so it's not like us old white people here on the panel, which kind of like played in the dirt and dust. But these are people that basically use the phone day in, day out. They have like apps that they are using. They basically switch around. And why does it only have to be like on the point of sale? Why can it not be integrated into things as like your health application, your other kind of like solutions that you're using on a day-to-day, where basically the underlying data and the application is analyzing your needs and then maybe giving you like nudges and recommendations of, hey, by the way, you might need this kind of like loan for health insurance and things like this. So I think rather than stickiness to an actual bank, it might more be like how to seamlessly integrate into your day-to-day operations.
And just to add to that, it's about the interaction. So the financial service at the point of interaction, because nobody wakes up in the morning and says, I need more financial services, I want to go banking. It's not an activity that we want to do. But at the point of interaction of a transaction, of a checkout, of the desire for a loan, or to buy something, or for insurance, whatever that use case is, at that point of interaction is where it matters. So the stickiness isn't to the bank, the stickiness is into the outcome of the interaction. So the example we had on Indonesia, the interactions are actually one of the big challenges the partner wanted to address was cart abandonment. What is the biggest cause of cart abandonment? And the number one cause was ability to pay. So if we can help address the ability to pay, we can reduce cart abandonment. And how do we then do that? Well, we can now, leveraging the bank, we can now do a alternative risk assessment on a customer and provide them a cash loan or a BNPL product that isn't just cash given to the bank, but it's then injected into what the customer perceives as their account inside the e-commerce site. And then the e-commerce player is able to use that as a funding source for an account-to-account transaction. And of course, because their acquisition costs of the payment have gone down, they can actually start doing alternative incentives as well. An 8% discount for a certain product if you check out via this approach. So you're creating the stickiness to the interaction. The financial service is actually is kind of the outcome of the interaction.
So it's all the customer experience.
It's all about the experience.
And I think the only thing that I would add to that, because both of them said it quite well, is I don't think we, as banks, they can no longer rely on customer stickiness, right? Maybe that was back in the day when maybe my parents had one banking relationship for 30, 40 years.
Yeah.
That's not going to happen anymore, right? The onboarding experiences of all the digital banks are within minutes, right? So the barrier to switch is now so low. So the embedded angle, I think, is you have to be where the customer is and where the need arises, and that's how you can create that stickiness. But is it intentional that some will say, hey, I'm gonna stick to this because that is there? No, it's because it's embedded in that journey at that brand. At least that's what my perspective is on that.
Sorry, maybe to add one more to this. I do think it's important to realize it's a fundamental different business model and a different customer, right? So we talk a lot about the end customer, but if you want to be, a bank offering banking as a service, your real customer are these partners. So if you actually have a very attractive proposition that says, if you bank with us, we have capabilities to actually make sure that your cart abandonment is going to be a lot lower than you just going with some plain old vanilla bank. That's your competitive advantage. It's no longer the detailed kind of customer journey that you decide as a bank. So really figuring out what your partners want and over delivering on that. That to me is one of the key reasons for stickiness as well.
Yeah, go on. You're right.
Oh, sorry, you go first.
Okay, so I'm from Australia. If we think about the Australian experience with some of the neobanks, Zinja fell over, Volt fell over, Judo banks going back to a fairly traditional sort of banking model. What is it about the notion of neobanks in Asia then that will avoid the story of Australia, where really the neobank experiment, if you believe the popular press, has failed?
You want to take that one?
No.
I think the problem that a lot of neobanks are facing is basically that they went into this kind of like issue that almost like all neobanks globally have, is like they have had to spend a lot of money to acquire customers through like high interest rates, and they basically didn't have a sustainable business model to make some money out of it. So I think that's plain and simple as it is. And what we are now seeing is like people or players on the market that are more intelligent of identifying those kind of like how can I integrate into user journeys to offer alternative funding, for example, to a demographic that traditionally is underserved or underbanked, with a lower kind of like acquisition cost because my technology cost is very low. This is the players where we think the success will be in the future, because just paying for customers through high interest rates is not going to be sustainable.
Yeah. And if you think about banking as a service, that's almost like the opposite of this, right? It is making sure that you partner with consumer brands that have very strong relationships, that you don't need to kind of fork out all of that money by saying we're the cheaper and you get higher interest rates, etc.
And just adding on, there's one extra bit on top of this about the cost of building the bank and running the bank. And this is where BAS offers a really good model for fintechs or aspiring banks, is that you don't actually need to become a regulated entity. A regulated entity comes with a lot of cost, a lot of effort, and a lot of risk, frankly. Because, to your point, getting a digibank license doesn't equal success, but it did equal a lot of capital outlay to get there. Whereas taking this approach, sure, you may not have as high a margin up, at the end point, but your cost of entry is very low. To not have to invest in regulation, to not have to build a team around it, to leverage somebody else's capability. And this is what banks are inherently good at: managing risk, managing regulation, reporting to the central bank, keeping the books clean, as it were. And that is a key asset that a bank can bring on top of the technology of BAS. And it really lowers that risk and that barrier to entry for an aspiring fintech or financial services player.
Yeah, I was just going to, slightly following on from that, ask about the data, who owns the customer data. There's three entities. sharing that can obviously be quite difficult across borders with regulation, but also overlaying that, what about an open banking world, you know, what that might mean, dare I say, open banking extends into energy sector, possibly retail, long term here, but interested in A, where the data sits, and B, how you share it, and then beyond that, what might happen with it, given the data is kind of the most valuable part around that.
Yeah. Mike, you laid out the different models. Do you want to share who owns the data in these different models?
Yeah. So ultimately, a customer, if they are to be regulated by the bank, they are a customer of the bank. Therefore, that's where the data lies. Like any banking product, if you sign up for a BaaS product, you will be signing a set of terms and conditions, and those terms and conditions will be with the bank. And at that point, there is from the bank to how do they have a data sharing agreement with the partner, because the partner brings data to the table as well. They might bring address information, they might bring shopping habits, they might bring purchasing history. So there's a data sharing piece there as well to consider, and that will be done on a kind of a case-by-case basis with what the partner's bringing to the table. But the underlying fact is that from a regulatory point of view, that customer belongs to the bank, therefore the data is the bank's data. I guess there was a second question around open banking.
Yeah.
So,
as consumers become more aware of that very thing, because right now they're kind of not.
yeah. So the open banking construct predominantly is around viewing information and authentication. And for the most part, in the first use cases, it started out around PFM, personal financial management, and sharing aggregated data, but there's not really any money in that, and the use cases itself are quite limited. So payments is where there's been a lot more traction, account-to-account and account-to-account authentication. It lowers the cost of transactions, and it provides a lot more transparency to the customer on data. The next bit really is what is the gap in data, because BaaS moves from viewing to transacting. So suddenly you're not just viewing your data, you're transacting, i.e. you're maybe doing origination, you're inputting your data, that data's being displayed in a third-party domain, and it's no longer viewing, it's now transactional. And this is where I would say there's a gap in regulation. There is because nearly all of the GDPR policies of a country cover this from a banking point of view, is how do you extend it and protect the consumer of that data being not necessarily shared, but transacted in a third-party domain, but under the bank's control. And I see BaaS as open banking as a subset of BaaS, but you don't necessarily need to regulate BaaS from a data point of view, because it's already covered under most countries' data regulation policies. But the transparency of the information to the customer is going to be critical.
Maybe just one point there from a technology perspective. So with AWS, yes, obviously services that allow you to text certain data. And working backwards then from policies in TNCs that you have, you can design your product in a way that it texts certain data that is supplied by that ecosystem partner. And let's say when one of the customers says, hey, I want to exit my banking relationship with this bank, you have the ability to then purge that data, and you have full auditability with that. So that is a service that actually some of our ecosystem players, I think you have used it as well.
I think it's fair to say that the open banking regulation is, in Southeast Asia is quite a bit behind versus where it is in Australia at the moment.
Just to reflect, the data question is one of my ones. Everyone here may have already seen the ChatGPT-5 and basically the data roadmap for a lot of the big large language models, and basically where it all leads is there's OpenAI already harvests and breaches copyright in relation to the data. The expectation from Microsoft, IBM, and all the other players in relation to data is actually around copyright in relation to private data. So just in relation to the partner data, how will that actually work in terms of, like, do you effectively have preset terms and conditions which partners are required to sign up to? Because presumably there's going to be a back license to the bank or the banking as a service to actually make this work.
I think it's very difficult to prescribe that right now. If you try to regulate as such the use cases, I think you're going to be stifling innovation. If a regulator comes and says, these are the types of data you can share, this is what, we don't know. I can tell you what, the next 3 to 6 months we can have a horizon of those use cases, but they're developing all the time, and they're very market driven. So to actually prescribe the data constructs today, I think would hinder the innovation. And not, obviously from a regulatory point of view, you probably cover off 90% of all that you need from a regulatory point of view from the existing regulation and data protection as well. This last 10%, I think the bank needs to take an independent view, and the regulator needs to take an independent view on the use cases as to what that data is, and the constraints of as and when it can or should be shared, and to your point then, the ownership of that data for future use.
To put it into context, I'm a lawyer. I also run a tech company. One of the questions we received from Australia, from an Australian bank, is basically is a data player, which is what are the anti-competitive aspects of we as a bank harvesting better information from our competitors and having deploying a better in-house LLM. So we actually have an iterative loop that allows us to basically dominate the marketplace.
Yeah, so I think one of the key things there is segregation of partner data. If a customer transacts on partner A, should that be beneficial then to partner B because of the information that the bank got? I think that's the bit that can get a bit grey of understanding of that cohabiting of data, because the bank will have a single view of the user. If they're on partner A, B, C, or D, it's still the same user at the bank's point of view. It's the same as still risk model that you're applying to that customer. And of course, your interactions across all of that reflects the risk model of that individual as well. So how that gets applied from one partner to the other, and which partner, and does a partner get benefit from one to the other, or do they actually commoditize that data as well? I think that's still quite early days to understand. Is it a revenue earning opportunity for the partner or the bank, or is it something that actually needs a lot more of a segregation between the partner to partner? And I think that bit needs to play out a little bit further still.
Thanks, Mike.
Philip, I had a question for you. It's Philip, right?
Felix.
Felix, sorry. Many of the neobanks and fintechs in general are cloud hosting the application providers like yourself. So is the default position that cloud host only can have access to the metadata, or is it something more than that?
Sorry, who has access to the metadata?
Let's say that you are hosting data for for a fintech or for a neobank. You're providing the servers and the entire environment and everything. Probably have a subcontractor relationship with whoever else is using your service. So I would think that you would generally have access to the metadata, right? Or no access to metadata and no access to data.
So the way it works like this. So there's obviously an outsourcing agreement with the bank if you're a fully regulated bank or fintech, and with that, all that is agreed in those terms. Now, you as the regulated bank will remain the owner of that data. So once you deploy it on AWS, you fully encrypt it in your web, and we don't have any access to this. Now, you could even choose to have those encryption keys on your own infrastructure, and we don't even have access to that.
No, very clear. It's just
Yeah. So moving to the cloud doesn't mean we have access to the data.
no, I know. It's just that I'm in a risk and a governance function. The same thing comes back in 50 different ways, essentially asking for the same thing, and you keep scratching your head. Is you missing something, or what's going on?
So obviously, as banks are now moving to the cloud, we are seeing this as one of the most important conversations we have. And there's I would say, still a lot of misunderstandings in the market, even in some of the larger banks. But we have compliance teams whose sole job it is to work backwards from the regulations and the internal risk policies of the banks, and then cascade all that out. And we spend a lot of time on that because it's very important that the regulated entity understands what they're outsourcing to us and how that is being protected.
Thank you.
You're welcome.
So maybe I have two more questions for you. So you can choose to be a bank or a fintech player, but somebody who's not using BaaS today, if you would kind of start this journey, what would be the one or two things that you say, start with that, or look out for this, that you don't make the mistake as so many other people have done before?
There is obviously a lot of mistakes that you can do, especially if you have like a legacy of infrastructure and services deployed in your environment already. So I think there is a lot of stories that I could tell you offline about like spaghetti architecture and kind of like intertwined systems that are deployed into current bank's environment, which actually makes you believe how is it actually working and how do I get money out of my bank account. But it seems to be working. But a lot of people that we are talking to, they are actually scared to touch that. And they are actually really worried that if they are touching that, what is going to happen to the rest of their customers. I can give you at least one example. There was one bank that we were dealing with, and they have asked us, because we were like about to deploy our system into their environment, and their infrastructure has been growing over like 30 or 40 years. And they have asked us, it's like, are we able to recommend them a network sniffer, because there is integrations into their core banking systems that have not been documented and they are not aware of what they are doing, so at least that they know where it's coming from. And these are the situations that incumbent banks probably are dealing with. And that's why we are having a lot of conversations across the region at the moment. How can we help them to modernize the architecture, or at least to create something like a sidecar, like a dedicated kind of like isolated environment that offers a solution to a problem statement that could be banking as a service, for example.
I guess I have to say, use the cloud, right? Jokes aside. So I believe if you're going to start this, don't start with your own business case, build it out in an infrastructure, and spend millions of dollars on capex. You don't need to do it anymore, right? You can start with a few $100s, experiment, and by using the cloud, you can exactly do that. Why I think this is so important, not just because of the business case, but it also allows you to experiment. You can run secure experiments at scale at a fraction of the cost. So the usual approach of, hey, I'm going to make this really work because we invested so much money in that, is no longer holds true. Now I can run 5 different experiments, each cost me only a few $1,000s, and I just turn them off, but I can run them at the same time. That is, I think, the approach that you should take if you start a new kind of business or have a new idea. And I think it also shortens your decision. In Amazon, we have this concept of one-way doors and two-way doors decisions. A one-way door decision means you have invested so much and you can't return. With a two-way door, you have the investment and kind of reduced, and you can go back, right? So if you're only investing a few $1,000s in this investment, you can easily return, right? And that's how we make a lot of decisions and how you get much more velocity in your decision-making process. Okay, thank you.
I wish I hadn't asked you to go first. I disagree. The reality, I think, is that I don't think there's an opportunity for experimentation anymore in this space, because the whole horse has bolted in some countries, because the ecosystem players are starting to come together. Banks at every level, tier 1, tier 2, tier 3, are making plays. But the first use case that a bank deploys, I won't say it has to be the one that writes the business case, but it has to be a massive driver of the business case. So you're only going to have in any market a handful of big partners that can give you that scale. So if you experiment, you might experiment for 12 or 18 months and someone else will have wrapped up the customer. The other piece on experimentation, I guess, which is the challenge in a regulated space, it doesn't matter if you're delivering it to one person or a million. If it's a live transaction, it needs to be regulated. So therefore, it actually needs to be a tech live platform. So it brings a lot of challenge with experimentation there. To Andreas's point of the things that can go wrong, I think if you looked at a technology stack to deliver banking as a service, most banks will go, we've got that, we've got that, we've got that, we've got that, we've got that. That may well be true, but it may well be difficult to integrate with. It may well have a product roadmap that is dependent on the core business of the bank, so making change to it would be very difficult. And I can pretty much guarantee it won't scale. And banking as a service is a scale play. The deployment we did in Indonesia, for example, for our customer, can handle 5 million concurrent users, not accounts, 5 million concurrent users at any point in time on the platform, supporting a legacy bank infrastructure. Because of the point of interaction being at the on the third parties, there's going to be a lot more load on the bank domain to manage this. So that is a massive consideration for a bank to take when they go through a build versus buy versus hybrid, is how can my existing platform, A, can I change it quickly to meet a fintech's demands, and B, will it scale to handle this volume of users?
Brilliant. And now my friends are going to hate me, but don't focus only on the technology. So don't forget who is really the customer, which customer segments are you going after, who are the right partners to do that, etc. It's something that actually I've seen a lot of people kind of forget as well. They kind of get a little bit too focused on the technology because it's so complex. I have one last question, and I'll cap it at 45 seconds each. So if you fast forward 5-7 years, who do you think are going to be the winners in this space, and why?
I'm going to stick to my experimentation, just because, yes, it's obviously regulated, but you can basically experiment with multiple partners at the same time. And the ones who do this and run multiple of these partnerships at the same time, and then are able to iterate on that, will be the winners. Obviously in a secure and compliant fashion.
I think winners out of this race are going to be banks that realize that banking as a service is not a solution that only addresses external requirements and needs, but also can give you like a scalable business model for your internal bank's requirements. So imagine as a technology leader in the bank, you're developing a scalable banking as a service proposition that can service all your internal lines of businesses, but also any sort of like external ecosystem partners. These are the ones that are going to succeed because they have the flexibility and the scalability.
Brilliant. And Mike, besides the people that use audax, who else is going to succeed?
Look, personally, you've got to get the business case right. So I think speed to market is going to be really important over the next 18 months of who creates the right strategic partnerships. That will then play out for what the next 5 years look like. But for me, it's really about creating that business structure and that business case, because the tech is just the tech, right? It's what you do with it, it's what you apply on top of it that really matters. So getting those fundamentals up front, I think, are going to be really important with those right partners to reach that scale in the next 3 to 5 years.
Fantastic, thank you. I think that's everything we had time for, unless yeah. So thank you very much for the thoughtful questions and for listening to us.